there's less market makers in crypto who are ready to warehouse risk, and so you see those wild swings in those second order parameters, and so that makes those reverse knockouts actually even more attractive when that skew is for the top side, when to be honest it shouldn't be.
Hi, I'm Dave Raquel, Director of Sales at Paradigm. Welcome to The Big Picture.
Policy reverting. So the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hey guys, so welcome to The Big Picture. My name is Joe Cruey. I'm at Paradigm, in the weeds around everything crypto vol markets. And today I'm joined here by a new Paradigm guest to the show, Sohan, on our sales team in Asia. Sohan, if you could just quickly introduce yourself, I think that'd be helpful.
Yeah, sure. Hey guys. So my name is Sohan. I'm a director of institutional sales out in Asia, and my background is on the TradFi side. I come from a structured products background, so structuring sales, always in FX and rates. And I moved over to Paradigm about a year and a bit ago. Looking forward to chatting.
All right, awesome. And today, very, very excited to say that our featured guest is Caroline Mauron, co-founder of OrBit Markets in Singapore. Thanks for joining us today.
Thank you. Thanks for having me.
Yeah, of course. So just to start, if you could just tell us about your background and how you transitioned from trading FX derivatives at Deutsche to now basically pioneering the crypto exo markets at OrBit. It definitely seems like quite the jump there.
Yeah, thanks. Sure. So like Georgia said, I spent 13 years at Deutsche Bank, mainly trading FX options, quite a bit of exotics, and I was co-head of the FX trading business for APAC in my last 3 years. I quit middle of 2021. I just kind of wanted to change and do something else, and I started looking into crypto after that, a few months after that. And I thought it was really interesting actually that the crypto vol market was pretty liquid. I think, Joe, you mentioned in one of the earlier podcasts that people at JP Morgan don't even know there's a vol market, and exactly. I was kind of one of these people. Like, I didn't really realize how liquid the vol market was, or that it even existed. So as I took some time off and I realized all these things, and I got really interested. And at the same time, I also realized that despite a liquid, fairly liquid vanilla options market, no one yet was doing exotics, which are, obviously you guys worked in IB, like in the typical options desk, whether that's in equity or in FX or in commodities, exotics and bespoke structured products tend to be quite a large part of the business. And so we were surprised that no one really was doing this in crypto. So we thought, that's an opportunity here. There's a gap. Well,
I think part of it is, like, as you said, right? Nobody really knows in TradFi, or not too many people know in TradFi, that there's actually a somewhat liquid, vanilla market here. And because of that liquidity, you can actually, replicate some of these payoffs.
Yeah, no, absolutely. It's quite interesting that, some of these products are being done in TradFi in very emerging currencies or in single stocks that really vanilla options barely trade, right? And so in that sense, like, crypto options are easily more liquid than some of these things. So yeah, crypto exotics can very legitimately be hedged, at least to some extent, and essentially run the same kind of business model as you do in an investment bank. So this is what we set out to do.
Awesome. That makes total sense. So typically when we record, the big picture, we discuss the crypto vanilla option flows in the market, macro environment. But given your crypto exotic lean, I feel like that would be kind of like a wasted opportunity. And the fact
we can do that too if you want.
No, it won't be as exciting, And the reality is, Paradigm doesn't yet see exotic flows on our platform because all the Paradigm trades are exchange settled, right? So I do think that today's format should be a little different, and we kind of dive into that world of crypto exo. And just to set the stage for people that might not have too much of a background in exotic derivatives. So exotic derivatives are types of financial derivatives that have features that are more complex or bespoke than, a traditional vanilla option, such as, bespoke payout structures, multiple underlying assets such as baskets, or unusual expiration dates. So yeah, I come from an equity exotics background where a lot of the structures that we were trading, were ones introducing discontinuity risks, such as, barriers or binaries, or, trading realized volatility or variance in swap formats, or, forward starting options, an option that begins a year from now in, January 2024, but has like an expiration in January 2025. So just wanted to set the stage there for viewers. But in terms of, crypto XO, it's like a fairly young market, but what sort of like products are you seeing demand for? And what are the sort of structures that tend to price attractively?
I feel like you've done my job already going through all the products.
No.
Yeah, look, I think like maybe one exotic product that's quite familiar and quite talked about in mainstream news is the variance swap, which is in equities known as the VIX. And that VIX index is very well known, and so people trade those variance swaps in TradFi. It's extremely liquid product, really, probably more or similar to vanilla options. Joe, you probably know better than me for equity, but this is a liquid product.
Yeah.
And so I'm from FX background, not so much, but still vol swaps and variance swaps are very common product. And we've also seen demand for these products in crypto, I think for exactly the same reason as they exist in TradFi. Basically, people have views on whether the market is going to be volatile or not. And they want to express those views without having to keep changing their position. If your view is that volatility is going to go up, well, you can buy an option. That's great. That's a good thing to do in the beginning. But then after spot starts moving, then maybe your exposure is not what you wanted it to be. Suddenly you have a directional exposure rather than a volatility exposure. And that's not your view anymore. So you need to keep rebalancing this thing, maybe sell that option, buy a new option, etc. People don't really like doing that. They don't like doing it.
So let's deep dive into that for our for our listeners, right? So let's say I have a view that volatility is going up. Traditionally, what I would do is I would just go in and buy a vanilla option and then delta hedge multiple times as spot is moving. And as spot moves far away from the strike, then my vega is less, and so I have to go in and buy a different option, etc. So you're basically outsourcing that entire function to you.
Yeah, exactly. You just you think volatility goes up, you just buy a so-called volatility swap, and your payout is exactly whatever the volatility ends up being, the realized volatility minus where you bought it. So that's a very clean way of taking a view on volatility, and all the nitty-gritty of doing the vanilla option, doing the delta hedges, rebalancing the vanilla options, etc. You don't have to worry about that. That's for us to do, and that's much more efficient for a dealer to do than for an individual trader, because we can aggregate all different positions, and we will have a lot of offset, so that we don't need to keep rebalancing each individual position, and that will give us economies of scale. Whereas if you're doing it for your own position, that becomes really expensive, all these rebalancing and rehedging. So that's one example that we've definitely seen demand for this year. Actually, both ways. Some people wanted to buy ETH volatility. I think our friends at Ribbon Finance were actually pitching that idea to buy ETH vol, and
so like an ETH, like a systematic ETH vol swap. That's offered to their vault investors. Interesting. Is that cap floored?
Yeah, exactly. Yeah, so that it has to be, the loss has to be floored because that basically that sets a maximum loss, and that fits into a vault format much better, or into any kind of DeFi format. And usually these things are just caps and floor. It kind of makes the payoff a little bit smoother for all parties. So we had some interest in that. That looked really good historically. If you look over the long term, essentially something always happens over a 3 months period. That you know, there are some non-volatile period, but if you look over 3 months, so something always ends up happening. So that looks good. At the same time, I think at the time, like a few weeks ago, the BTC vol versus ETH vol, that looked a little bit like not wide enough. Like BTC vol was a bit too high as compared to ETH vol if you compare to realize. So some people were interested to sell the BTC vol swap.
So will you show spreads as well? Have you seen like interest in the spread where like, you know, sell BTC buy ETH, especially with the Shanghai upgrade, you know, coming now, and you know the massive rally that we had you know, in BTC versus ETH, you know, I could see people kind of looking at that trade.
Yeah, no, totally. I think that makes total sense now with the Shanghai upgrade. I actually think people are maybe like not really paying enough attention because nothing happened on the merge, and now it's like, oh, whatever happens on the ETH chain, you know, it's just non-event. But this one might actually has like supply and demand effect more so than the merge. So I think it could be interesting, and we've definitely had interest all over that event.
Yeah, I mean, just speaking to the vanilla options market, we saw so much, you know, interest in demand for premium like ahead of the merge, and I mean a lot of that kind of just, you know, went to waste, right? And so far around the upgrade, as you say, that has, you know, much larger supply demand implications. We really haven't seen anything yet, right? Like it could be the case, you know, people are going to wait until next month to start putting on those views, but as of now, they just really haven't. So we'll see.
Yeah, the event is barely priced in, right? There's like barely noticeable term structure on the March contract. Yeah, so it's cheap at the moment, I would say.
Right, and I mean just like operationally as well, right? Like there's also just like technology risk that's just not baked in, right? You know, where something has the potential to go wrong. So like, okay, so how do you guys see this, you know, the crypto exotic market, you know, evolving going forward? Like, are you guys seeing interest from like for example, I come from the equity vol background. We were doing like a lot of like structured note business, right? You know, like the worst of auto calls, you know, out of, you know, the Japanese and Korean family offices was quite massive, right? So just for the viewers, effectively what these structures do is they combine a coupon payment with a short worst of knock-in put on a basket of underlyings, you know, S&P, Euro stock, and Nikkei, for example. In equities would be like a very common auto call. These things would have like a 2 to 4 year maturity, and given effectively whoever owned this note had this long covariance exposure on a basket of highly correlated assets, you could collect some optimally, you know, attractive yields on this stuff, right? So are you guys starting to see, you know, some demand for that sort of stuff? It kind of seems like a logical target audience if these guys are kind of looking to collect these juicy yields already in equities. I mean, hell, what happens when you put a basket of BTC, ETH, and I mean, God forbid, Solana? I mean, let's hope none of those were, because those would have knocked, right? Those would have knocked and would have got nasty. Like, have you guys seen any demand for that stuff?
Yeah, I mean, look, it's a bit, I would say it's a bit different from what we see in TradFi. Like in TradFi, this business is very well, the infrastructure is very well defined. You know, there's the distribution partner in Japan and Korea, and then there's the issuer, and then there's the investment bank acting as the swap dealer. And so all these things have been happening for 20 years, and the process is very well defined and like smooth. I think that, I mean, we are nowhere near in crypto at the moment of having all that infrastructure in place and all the different roles well set up. So we're ready to be a dealer in these products. We've done them.
Yeah, I mean, maybe yeah. Please keep going.
Yeah, look, I think those products are very complex. You know, as
yeah. I mean, I was literally about to be like, can we talk about something simpler? Like, I guess in terms of like the way Paradigm works, right? We have a bunch of market makers, and then we have a bunch of takers that come in occasionally to express a very directional view. So these hedge funds or risk takers, they are completely not taking a vol view, right? They're coming in to do like a very specific look. ETH is going to go to this level, right? I mean, for those guys, is like something more like first generation exotic, like a knock-in, knockout type instrument. I mean, do you offer that to hedge funds?
Yeah, totally. I think the simpler product and probably the most popular as well is the reverse knockout in terms of those directional type trades. So maybe for those who are not familiar with the product, if you take an example, let's say you think ETH is going to go up between now and end of March. You want to buy an ETH call, but that's quite expensive. So, okay, you're looking to cheapen it up. So one simple way and common way to do that is to buy a call spread, which people do. So maybe you buy 31st of March, 1700, 2100 call spread, and it'll cost you, I don't know, 5% or something. But you can cheapen that further. And one common way to do this is to say, okay, actually, if spot goes over 2100 at any time during the life of the trade, then I'll get nothing. So with the call spread, if it's over 2100, your payoff is capped, but you still get something, and it can go up at any time and come back down, etc. But with the reverse knockout, it needs to never go over 2100. If it does, you get zero. So your view is that it's going to go up, but not quite that much. 2100 is pretty far. Yeah. And if you have that view, you can get the option for much cheaper, about 2%. Like I'm throwing numbers, like those numbers move around, but that around that kind of discount, so very meaningful discount.
Yeah. On a similar note, have you guys looked at appearing call spreads?
What's call spread? Sorry.
An appearing call spread. So you're long a vanilla call, and then you're short a further out of the money call with a knock-in higher, right? So you have the vanilla option exposure, but then if you knock in, it just goes to the call spread.
Yeah. That's quite common as well. Yeah, I think at the moment, I would say people seem to prefer the RKO format, but I mean,
I guess it's a very similar view, right? It's like it's going to go up, but it's not going to go up too much. But like
exactly,
if you summarize,
you get something with your setup, Joe. Like if it goes way through, you still get something. Yeah, that's the.
Yeah, I mean, let's say a big client comes in and says, look, I think Shanghai upgrade is going to be a really a big event, but it's really, we're not in the right macro environment for it to really roof it, right? So as spot goes up, there's going to be a lot of selling pressure because, a lot of people, suddenly they're not down as much as they used to be, right? So, like for them, the option is like that, as in the three things that they can do is either buy a call, right? And then buy a call spread, which they can do on Deribit or another exchange. And then OTC, they can do an RKO or like an appearing call spread or something like that, which is even more leverage, right? And you get twice as much. Is it like about 50% off? Like if you in that example that you just gave?
Yeah, I think usually even a bit more. Like people will look to like 60-70% discount, that sort of thing.
Yeah, the upside skew is so jacked out there, right? You can really get a lot of discount by selling those strikes. I mean it makes sense. I mean, look at like the upside realized that ETH or even BTC can potentially have. I mean, look at the beginning of the year, right? You move 40% in 2 weeks. So it totally makes sense. Like in the equity world, we were doing a fair amount of these, like on like FXI, for example, or like the Chinese internet names that can just absolutely have like massive moves to the upside and there was a lot of interest in these structures just because you could just get absurd discounts that were optically quite attractive.
That makes a lot of sense. Sorry, go ahead.
I think just on Joe's point, right? Like I actually think it makes a lot of sense, even for those people who think there is going to be a 40% move, right? Because in a 40% move, in most cases, people are long cash, long delta, long vol. Like they have all these alts which are really pumping at that time, look, do you really care that you lost the premium that you bought on this option, right? Like, I mean, at that point, you're pretty happy anyway, right? So it's kind of like a levered way for you to, you know, have the view that it grinds higher.
Yeah, and I think the way you pitch it is from like a portfolio diversification perspective, right? It's like, okay, like if you're allocating X amount of cash to just like vanilla calls right now, like why don't we take like 25% of that premium allocation and then throw them in, you know, put them in these knockouts, right? Like that was a very, very common thing, you know, from some of the big traditional asset managers who didn't have such a strong view on path. I mean, especially with crypto, like how could you, right? Like, so in order to kind of, you know, reduce that premium outlay and, you know, get exposure, or on the same token, get exposure to a higher amount of notional, you know, taking, you know, some of that portfolio allocation, then putting them into some of these barriers, I think makes a lot of sense.
I think it looks particularly good sometimes in crypto because the skew tends to be not very consistently priced, I would say. Like the risk reversal, it varies a lot. You know, it swings wildly from like very positive to very negative, and you wouldn't see that in TradFi. Like I think there's less market makers in crypto who are ready to warehouse risk, and so you see those wild swings in those second order parameters, and so that makes those reverse knockouts actually even more attractive when that skew is for the top side, when to be honest it shouldn't be, like, or at least not for the long term, you know. So
and the long dated is still calls over in BTC. I mean,
yeah,
crazy, right? You know, it's been like a month or so of like doing nothing, right? You know, we're kind of just sitting here. Yeah, that's
yeah. I mean,
ahead,
I mean, if we talk about the skew, right? Like, I think maybe it'd be good to understand exactly how you hedge these instruments. I mean, I understand it's a model and it's complicated, etc. But like roughly, like how would you hedge this 1700, 2100 RKO when it, you know, if somebody traded it today?
Yeah, of course. So like usually we would look at it in a kind of portfolio approach. So, you know, we have lots of different trades and none of them are exactly hedgeable. But then as a portfolio, you look at the overall kind of sensitivity to different parameters. The most obvious parameters are spot and vol. So we would very systematically hedge those. And then you have exposure to other parameter like the skew, like we just talked about, the shape of the surface, etc. So this is a bit kind of abstract way of thinking about it. Basically, you have your entire portfolio and you look at your sensitivity and you try to match that. But if you think about it more like, I guess, granular way, so you just have one exotic, you don't have a whole portfolio, then what do you do with that one exotic? Then you definitely have some pretty close hedges. You know, if you think about a simple European knockout, so the product I described earlier, the knockout is so-called continuous, meaning it's observed from the trade date all the way to the expiry anytime. But maybe a simpler product to hedge is what's called a European knockout, where you only observe the knockout at the end, like on the expiry date. So those products can theoretically be hedged exactly. You know, you have to buy the vanilla strike, like the 1700, and then for that 2100 digital, you have to do a call spread around it to hedge. And the tighter the call spread, the better the hedge. In TradFi or OTC, you can do as tight a call spread as people will quote it. In a listed exchange market, then you're restricted to whatever are the listed strikes around it. So the hedges are not going to be perfect, but you know, that would, if you did like 1700, 2100, 2200 type fly, and then you kind of match the notionals to be roughly there, that will be, you know, a pretty good hedge to a European knockout. Now for the continuous knockout, that's a bit different because, well, if spot goes up very quickly, you know, you can put on your static hedge like I just described, but then spot goes through very quickly, 2100 knocks out, then the option is gone. The exotic option, that option has nothing left, doesn't exist anymore. Then you need to unwind your hedges. So you don't want to be putting on very exact hedges, that maybe you won't need. So there's like some probability adjustment in terms of what exactly you should be hedging or how much you should be hedging, and what ratio of it that comes from pricing models. Yeah. I hope that's clear enough.
Yeah, I mean, I think
that was super.
Yeah, that's very clear. Yeah. I think it would be interesting to know how much, like when you hedge, because all of this is OTC, right? So you're directly facing, like a hedge fund or some kind of risk taker, and they buy this option from you. So when they trade against you, it's OTC. But then when you hedge, in general, do you use the OTC market or the exchange market to hedge?
No, look, if we have any risk that we need to hedge, the primary venue in crypto is clearly derivative, like including via Paradigm. Obviously, you guys are like the top venue to find liquidity. So the question is more, how much do you need to hedge? If like when I worked at banks in TradFi, people talk about something called the internalization ratio, which is if a client does 100 of something, how much do you need to actually go and hedge outside, and how much can you internalize? And the target is to have as high as possible an internalization ratio. Banks like in the spot market, they will target 98, 99, 99 point something %. And so, well, why is that? Firstly, is that as a dealer, you don't spend fees, you don't cross spreads, and secondly, you reduce market impact also for your client because you don't go and hedge everything they do. So that kind of a high internalization ratio is ideal for both sides, and that can only be achieved with a big network and a big client franchise of people who do different things and have different interests. I don't think the ratios of like internalization ratio of dealers in crypto are anywhere near what they are at banks, but that's kind of the target. And then whatever residual risk you have, as far as crypto options go, certainly is via derivative and Paradigm at the moment. Open for changes, but at the moment this is it.
Yeah, it's just, I mean, like I mentioned, you guys are kind of the first ones here, right? And you need to have, like the former equity business, you have that two-way flow, and you're able to internalize a lot of risk because risk that I'm putting in my Exo books, I can kind of repackage them and out to hedge funds, right? And to hedge funds that are looking to just buy vanilla options, right? I want to shift gears a little bit. So I hear you guys are offering, you're doing some, and you did allude to it, some like DeFi exotic options, right? Like I read there was something you guys were doing around impermanent loss in Uniswap liquidity pools. And this is really interesting to me because this is like one of the first examples of an exotic that hedges an exposure that is non-existent in TradFi, right? We've been talking about like barriers and like vol, var swap, like all these things are already existing in the TradFi vol markets. It's just you just have a different underlying asset. But like what you guys were talking about in hedging impermanent loss, well, that's a concept that's unique to crypto. Like I would love to hear more about that.
Yeah, no, totally. Actually, when it was shortly after I quit my job and I started reading about crypto, and I read about this Uniswap impermanent loss, and it was kind of, I thought it was interesting, so I read a few Medium articles, and the more I read, the more I realized, this is just another exotic option. Like I can definitely price that. So it was kind of the first things that got me interested into crypto. So I'm definitely happy to talk about it. Yeah, so the impermanent loss on Uniswap, essentially when you provide liquidity on Uniswap, so let's say you provide on the ETH USDC pool, and your exposure, like we can keep it to V2 to keep things simple. Your exposure is half and half USDC and ETH. And so like in the simplest analysis, you might think that, well, you just have 50% sensitivity exposure to ETH and the other half is just in dollar, and that's that. But that's not quite that, because of the setup of the automated market maker, the formula, and the way Uniswap works. you end up having some short convexity exposure, and that has a well-defined payoff, which is, well, the formula is a bit messy. Like there's for V2 there's one square root. For V3 there's like quite a few square roots in the formula.
Yeah, because V3 you need to set the range as well in terms of the price range in which you want to be an LP, right?
Yeah, exactly. But ultimately, this is something that you can, the payoff is just one formula, and you can get that in Excel, and that's going to be however much you lose on that impermanent loss effect, as compared to what you would have got with just a simple half and half USDC and ETH exposure. So that is just, when you have a payoff formula like this, that's deterministic, in the sense you just need the spot at the beginning and the spot at the end, and you have a formula that determines how much you're going to make or lose. That's something that can be priced. Like that is exactly the definition of an exotic option, I think. Yeah. Any payoff formula that isn't a call or a put, then that's an exotic option. So this is what this was, and so we can price it with our standard pricing model, and we can hedge it in the kind of more abstract way that I described earlier, where you look at the sensitivity and you try to hedge and replicate the payoff as close as possible with the vanillas that do trade on the exchange. And that's actually pretty easy to do, because that's a European payoff. Like I was going through earlier on the barriers. When payoffs are European, meaning they only depend on spot at start and spot at end, they're a lot easier to hedge, and the impermanent loss is European. So this is something that we've been talking about with various funds and people who are interested in DeFi and who've been providing liquidity on Uniswap or other forks like similar to Uniswap. And yeah, we've had a lot of interest in people looking to hedge impermanent loss. We've seen different approach, like some people just buy a long-term V2 hedge, 1 year V2 hedge, and then they probably do some rebalancing of their exposure, but they don't rebalance the impermanent loss hedge. Like they just keep that as a macro hedge, I think, to their portfolio. Right. We've also seen people doing very, I would say, advanced strategies on the V3 liquidity provision, which I'm not expert in, but if you look at like exactly which range has less liquidity but is likely to trade, you're going to earn more fees than you can provide liquidity in that range. It's going to be more profitable. So they try to hedge exactly those range that they provide liquidity for. They hedge that impermanent loss, and then they keep rebalancing to make it right. So we see different approaches, but it's definitely been, it's had a lot of interest.
Right. Yeah. So yeah, at the end of the day, it just seems like a short gamma exposure, and that's just a function of the final price, but it's independent of the path, right? Like you were talking about like hedging continuous barrier options, right? This sounds like, from a replication standpoint, sounds a lot less complicated than a continuous barrier option as path dependency. And then you have the listed derivate market already that is quite liquid. So you have this implied probability distribution of, for a given expiry, and then you just apply that distribution to the different potential final prices, and that determines the expected impermanent loss. And then you just wrap a contract for difference around it and charge a fee on top. Similar to a fixed versus floating interest rate swap, because you're giving a liquidity provider this opportunity to lock in an impermanent loss. Is that kind of sound right?
Yeah, no, that's exactly right. Yeah.
Okay.
I mean, I think the even bigger thing is, this is like, so far we've talked about very sophisticated investors, right? They have a very very simple view on where ETH is going. This could be mom and pop, right? Like, because literally anyone could put money into Uniswap, and then they could come in and they could hedge.
Yeah, I guess it would need to be packaged by some intermediary, where you can provide liquidity on Uniswap in a hedged way, and then that intermediary is kind of buying the hedge from a dealer like us or others. So I think that comes back a little bit to what we were saying earlier on the notes. Like, it lacks a little bit of market infrastructure and people having the role of trading with the final end clients and issuing those whatever the exact format needs to be in each country. So all these things are not there yet, I feel. So currently, the main interest has been coming from very much institutional investor, like hedge funds type. Yeah.
Right. I read something that you guys are also looking to do something similar with staking yields, right? It's kind of a similar problem. If you're somebody that's trying to lock in that yield, you can structure that as a fixed versus floating as well, right? Obviously, a lot more variables at play here that you need to take account for. But can you tell us about that? What you're looking to do there?
Yeah, definitely. I guess the underlying source of the yield is a bit different. You know, in Uniswap, you earn the yield because people pay fees when they trade on the Uniswap decentralized exchange. In the case of the staking yield, well, the yield is coming from essentially people using the blockchain. So the more the blockchain is being used, the more fees are being generated. And so by staking the ETH you have, you can earn some of those fees as a yield. The difficulty with that, I think, especially for institutional investors probably, is that yield is completely unknown and variable. It changes every day. So one of the main DeFi staking services at the moment, the Lido protocol, so they publish an APR every day that's coming from transaction on blockchain. And you don't know, you know, if you stake some ETH in there, then every day you find out how much you earn, and that's it. So if you're planning to earn yield for 3 months, then you really have no idea how much you're going to earn over 3 months. So that makes it quite difficult, like that lack of predictability, I think, for some investors. Right. So we've been offering the option to swap that variable rate into a fixed rate. Then, you know, let's say you're an investor who's staked your ETH into Lido. Then the investor is going to pay us the variable rate they earn in Lido, and we're going to pay them a fixed rate. So this is really very much like a fixed floating interest rate swap in TradFi, you know, where you don't exactly know where the Fed fund rate is going to be, or Ionia, or whatever is the short rate in the country, but you want a fixed rate, so you do an interest rate swap to fix it.
Very, very, very interesting. Okay, so the last thing that I want to talk about that applies not only to CryptoXO, but all crypto derivative markets is this whole concept of, you know, OTC counterparty risk, right? It's certainly on the top of mind of all our crypto derivative investors, you know, given the credit crisis we've had. And I mean, hell, you think crypto spot's volatile, then you add derivatives on top of it with, you know, exotic wrappers, and it's like, wow, right? Like, and in traditional markets, you know, you can have custodians, you can have these tri-party agreements to help mitigate, you know, some of this risk, but it doesn't really exist here yet, right? Like, what are things that, you know, OrBit has been doing in order to manage that counterparty risk discussion around an exotic offering, and, you know, how have you guys been, you know, giving investors confidence around that?
So I feel for counterparty risk, I don't think it makes too much of a difference if you're doing a very simple product or a very exotic one. You know, as long as the potential loss is the same, or potential profit for the other side. You know, if that's very explosive, like in a variance swap, then okay, that's an extra problem. Right. But if it's some kind of linear payoff, then, you know, then it's basically the same. So that still makes it a big problem in crypto. So I think, like, to me, one of the biggest issues with the counterparty risk is the lack of transparency, because in TradFi you trade from one bank to another, or even one bank to a fund, but there's a lot of transparency around counterparties' financials, and that gives a lot of confidence when you trade, right? But in crypto there's very little transparency, and not just that, even if you have audited financials, well, these only come once a year, and 1 year in crypto is an eternity, right? Like it's a much shorter time frame than in TradFi. So that just kind of makes it difficult to have confidence to trade with different counterparties and take risk. I think the standard setup of exchanging collateral every day based on the mark-to-market, that is like absolutely standard in banking. I think that's a good thing. Like that works pretty well, and that reduces risk for both parties. It doesn't make the risk zero, but it does reduce it materially to however much the mark-to-market can move over 1 day. So that makes it much better. I think the overall full setup with custodians, that's still very nascent, I would say, at this stage.
Yeah.
There are some decentralized solutions to this, like we've had counterparties interested to use Gnosis Safe. I think the brand is Safe now, which we think is actually potentially a pretty good alternative to custodians, like essentially multisig wallet that lock the margin. So I think that's still not completely clear how that can work, and there's still a lot of questions around operational controls, but potentially it could be very scalable. And thanks to the DeFi setup, where you can have liquidity tokens, and then those tokens might be in the safe, but you could still stake them somewhere. You could earn a yield. Like it's quite composable. So potentially, I think there's a lot to be done, and there's a lot to build there.
Yeah, I hear you. I mean, Sohan, we should build this stuff, right? Like
I was just about to say what we need is a central
OTC
clearing house.
multi-sig wallet, right? Like no party has singular control over it, right? Both parties need to approve a transfer of collateral, right? Like it's not like multi-sig is like a very novel concept in crypto, right? Like this has been around for quite a while, right? And if Paradigm is looking to pivot towards DeFi, like eventually, right? This could potentially solve the entire bilateral OTC trust issue, right? That is affecting all our market, right? And so like speed of settlement, number one, no need for intermediaries, number two, lower cost. Number three, it's asset class agnostic, right? You could easily bring like this sort of concept and bring it to equity derivatives, bring it to FX derivatives, right? And then you can also have this automated collateral transfer because of the open source nature of the contract, right? You're able to monitor the mark to market in real time, and even like the daily collateral management, right? At banks, right? You have so many people that are in the weeds doing it, and it's always causing constant headaches for customers, right? Like, I mean, it's easier said than done, but like, I don't know, it kind of feels like DeFi is the answer here, especially when the CeFi solutions, like you're not getting the big custodians coming into crypto. Like all like the big all the stablecoin stuff, right? Is like FTX, what have you, is setting it back, right? Like BNY, like the biggest custodian, is not coming into crypto custody anytime soon, right?
Aren't they in it?
Yeah, I mean, I think.
Are they?
I think so.
Then why are we working with them?
I think the main thing is like you just need. I mean, the clear need here is that for all these complex payoff, you need either a centralized clearing exchange or like an LCH type, type entity, or you need a DeFi solution, right? I still think there's like it's mixed, right? Like some people just can't take DeFi, right? Like, I mean, smart contract risk is just not something people can take, and then likewise, some people just can't take CeFi credit risk. So it's I think you're gonna have both solutions. I think concurrently, coming to the front.
Yeah, but like I would trust
yes,
well-written code that has been audited more than just like some black box balance sheet where I don't know what the hell is behind it.
Yeah, I mean, 100%. Yeah, I mean, good idea. We should definitely build this.
Alpha.
Why don't I go off and do that, right? Let's catch up tomorrow. I'll be done.
Yeah, exactly. Well, that's everything for me. It's been 45 minutes. It's been a great conversation. Any closing thoughts, or are we good to end it here?
No, yeah, thanks very much for having me. Great having a conversation with you, and yeah, look forward to keep working with you guys.